So welcome to a live recording episode into the Financial Pro community for the Financial Pro podcast with Daniel Mach, one of my mentees, one of a mortgage advisor. Funnily enough, we were both at Alexander Hall at the same time, but didn't necessarily cross paths at that time. I think I kept myself squeaky clean when it came to compliance. But how you doing, Daniel?
Yeah, I'm good. I'm good, thank you. How about yourself?
Yeah, all good. Can't grumble. Friday afternoon, Friday morning even. It feels like half the day's gone.
Wishing the week away.
Yeah, exactly. So the one of the reasons to give people context in terms of why I wanted you to come onto the podcast. Obviously, we had a chat in London and a coffee, and you've been part of the academy for a period of time. But your extensive knowledge of the actual financial services industry and how it works as a DA, an AR, an employee, an employer, everything, I think is just going to be hugely valuable to the audience. So can you kick us off with kind of a wee bit of backstory, bring us from how you got into FS kind of up to current date, and we'll then just have a chat and see where we go.
Yeah, absolutely. So I actually started out in pharmaceuticals doing quality assurance and quality control. So I did that for about 3 years, and then through mutual friends, ended up at a kind of a summer party for who was then the head of compliance for Alexander Hall. And I was frustrated and looking to move on to new challenges. And he was having trouble recruiting someone from within the industry. And we ended up having a slightly random, evening conversation where he's saying, I've got the skills, but don't know the industry. And we went from there, had a couple of interviews, and next thing I know, I'm at Alexander Hall for 5 years. So I started there as compliance, regular compliance officer, audits, T&C scheme, sitting in on client meetings, monitoring financial promotions, complaints, all that type of stuff. Endowment reviews was also a big part of it then. And then I was very fortunate to be there at the right time, effectively. And I think that's probably been true a lot of my career. They were just about to go through a massive growth phase, which you probably recall. And so when I joined, it was just before mortgage regulation came in, literally the week before in 2004. They lost a load of people through that and then decided that there was a real opportunity and wanted to go for it. So they created a new training function. And I had a very good working relationship with the sales director. So I was basically asked to take that on. So we went from about 30 advisors to around 100 advisors at the point at its height. And I managed all of that for 2 to 3 years. And then I left in 2009 after, obviously, things were getting a bit tight. So my role was slowly eroding, and I decided to move on to other things again. So I went to a company called John Lamb, which was high net worth IFAs, London landed estates, some international clients, and that gave me my first real insight into the high net worth space, because that was, it was lords, ladies, dukes, old aristocracy, new money, entrepreneurs. It was everything, and it was a really, really interesting company. So I was there for a few years, took a sabbatical, which was great. And then came back, did some consulting, and that really was my then first taste of being self-employed. So I did some work for big banks, for management consultancies, did some PPI contracts because they were, frankly, they paid ridiculously well. So really hopped around and tried a load of different things for several years, and then ended up at Octopus Capital. At that point, they were a bit smaller, so they were about 250 people, had about 500, but they had about 5 billion assets under management, and they hadn't really branched out into things like hospitality and energy or healthcare. It was just alternative investment vehicles and a bit of property, so Dragonfly as it was then. Worked with the management team there on dealing with legacy issues and backbook problems. There was something I heard you talking about the other day about delving into like the guts of a problem and rolling things back and working out where things had gone wrong. So I was doing a lot of that. We call it root cause analysis. So we had all these big projects, and that was really actually quite exciting to work with the founders and the management team there. we had false reviews, we had the FCA in, we had the lawyers in all the time. It was really quite like meaty, interesting work. And then from that, I went back to property and mortgages and joined Ennis. So that some people may know Ennis now as Ennis Global. They were Ennis private clients at that point. And I think I was, other than the owner's PA, I was the first non-advising role there. So set up compliance, helped set up marketing. I was in charge of all the recruitment, moved from being an AR to a DA, obviously had all of the regulation changes that happened over the ensuing years. And we grew from a company of 12 to, again, at its height, we were about 60 people. Went from being at a little 12-person serviced office to having two London locations and opening our first international location. So that was also really, really exciting and challenging roles.
What years was that roughly?
Sorry?
What years was that roughly with Ennis?
That would have been 2013 to end of 2013 to the start of 2017.
Okay,
2016.
years.
Yeah. Yeah, through about 3.5 years. So I need to work out my dates, but about 3.5 years. Did a year with Knight Frank Finance from that, working with the partners. So working with Simon Gammon and the rest of the equity partners on a variety of things. It's interesting seeing the relationship in the structure from an LLP versus a limited company, and particularly when you've got two levels of LLP. Because you have Knight Frank Finance and then broader, international Knight Frank. So that was really interesting. And then from there, did some other bits of consulting and then went on to JLM, which is a brokerage and a small network. And I was their chief operating officer for a while and then have done some consulting with them on the side since I decided to take the plunge and set up fully on my own.
And when did you launch on your own? So when did you actually become a broker yourself with your own? Because you're
18 months
at the present time, aren't you?
I am an AR of JLM, yeah. So I was the COO for just over a year, which was an interim role. Then I carried on doing some consulting with them while I was doing some other bits, and then set up fully under them as an AR, still doing some management consulting for them as well.
Yeah. So how long have you actually been back to advising?
18 months.
18 months. Yeah. So that's one hell of a journey from 2004 till 2002 up till the current date, isn't it? It's a lot of variety.
Yeah, not to present myself in a certain way, but yes, I've certainly been around the block, as it were.
But there's pros and cons in that, isn't there? It's like often, when you're recruiting, you don't want to look at a CV and see too much in relation to job hopping and changing and things like that. And it's one of the things but the experience that you've had in the same way, there's you and I have spoken before, and there's been a reason why you've moved on from every single one that you've had. Mine was job hopping for 4 years because no one was giving me enough leads to deal with. And it's the experience that you've gained in such a wide variety of places as obviously why you're on the podcast, to be honest.
Yeah, and a lot of it was consulting. So my Knight Frank contract, for example, was a 9-month contract. We rolled it on for an extra 2 months to do a couple of extra pieces of work, and then that was that. It was I wasn't in house. It wasn't a full-time role. It was it was what it was, and it's but for everyone that's self-employed, there are always challenges with finding clients, time commitments, things lining up properly, but equally, from my perspective, I'm very grateful because it has given me such an insight into so many different companies and cultures and ways of working, and basically everything there is to I say everything, being slightly arrogant there, but I've seen a lot about how businesses are run and what needs to go into them, and that's been of real use to me.
Yeah, without a doubt, and it's that whole thing of experience will always trump, reading a book or looking at manuals or podcasts or courses or whatever. Being at AH, for example, for that period of time, and I was at AH in 2005, which was just before they closed down the Lombard office and wanted to shove everybody into the Foxtons offices.
Yeah, on Curtin Road.
Yeah, that was it. So it was like nice, easy journey coming into Chelmsford, although I never enjoyed the being at 8 o'clock and leave at 9 o'clock. The amount of 8 o'clock appointments. Yeah, the amount of 8 p.m. appointments that I had to I rebooked and recancelled and moved. I was like, sorry, can't do this. But I think one of the good things to start off with, having got your background now, and I think it'll be valuable for particularly new people in the industry, but also, you know, seasoned pros. Your compliance knowledge is extensive. You consult for JLM. Roughly how many advisors have JLM got now?
Now they are up to about 75 to 80, something like that, maybe even a bit more.
So you've been in a position of kind of high power, shall we say, where you were monitoring and managing 75 advisors pre-credit crunch and been involved with a business and also consulting quite heavily for them as COO in a business in New World Mortgages. Can you give the audience the context between, and I've done this before, but can you give it from your perspective of, I like to call them the good old days versus the hardship now? Because I think it's a great explanation as to why I'm so passionate about brokers charging fees, for one thing.
Yeah, absolutely. I mean, I think, so if you take it right back to Alexander Hall, for example, and the model you'll remember there as well, joining just before mortgage regulation came in, and then obviously dealing with all of their historic complaints and past business reviews as well. There was a period where compliance was, you could, in the city, for example, you could do a meeting and the sign up on the back of a bar napkin, and it happened. I'm not joking. I've had complaints where people have said to me, I should have known something wasn't quite right because he literally wrote it on the back of the bar napkin. Or he lifted up his pie and wrote the figures down, and that was that. And so that is the real good old days. And whereas we're in a position now where we've been through, in the past 20 years, we've been through 3 regulators, because obviously there was pre-FCA, FCA, and now FSA. So we've got 3 regulators. We've had a handful of regulation changes. We've also now had input from European law and legislation, which was aimed at homogenizing mortgages across the continent, but based on the euro instead of individual currencies. So that's obviously created some issues. We've had massive changes in particularly money laundering and anything to do with fraud, sources of wealth, sources of funds. There's been so many new laws that individually, each of those things that I've just mentioned hasn't in and of itself radically changed how we have to do what we do, but cumulatively it's massive. So whereas before, a mortgage illustration, for example, would be a page, and you could, or a couple of pages, and you could write your justification in a paragraph, get some ID, maybe get whatever the lender wanted. But if it was fast tracked or self-cert, for those of you that remember that, you're looking at a file that's could be as little as 3 documents versus now, which obviously you all know. And time-wise, that's huge. So if you go back to, again, if we look at seeing as that's what we both know, advisors there would have been expected to do 3 meetings a day, typically 1 at lunch and 2 in an evening, as well as phone calls, chasing applications, all the works. Completely. Call out sessions, all of those. But that was the minimum, and that was just when you were starting. Once you were up and running, you were expected to basically be back to back all day and to be converting a third of the people that you see. And you could do that. You can't do that now. It's just physically not possible with the amount of documentation and justification and compliance that you now have to do.
Yeah, without a doubt. And it's that whole thing of, exactly you said, below 75% loan to value, nothing other than a signed piece of paper saying I could afford this. I knew brokers then that were charging 1% to do a self-cert mortgage. It was just it was insane. And we were getting higher proc fees back then as well. It was a crazy world.
Yeah, and I mean, look, don't get me wrong, there are some good reasons why some of these things have changed. Because again, at that time, I worked with, not just at but in other places as well. I worked with teams that dealt with adverse, subprime credit, credit impaired, whatever you want to call it. And it was exactly that kind of debt spiral. They come in with a little bit of adverse and you put them with someone, and then they carry on being really bad and they come back in 2 years and you put them with someone else, and you're basically spiraling them down, and they're borrowing ever increasing amounts of money at ever increasing rates. And all you're doing each time is basically just taking their credit report, giving it to the next adverse lender on the list, and just shuffling them through. And so there were these kind of practices that you look back on now and go, God, did that really happen? But it did. And that, we do, I think as an industry, what we sometimes forget is we do have to look at ourselves and look at our practices and say, what we do now actually is going to determine what our compliance is like in 5 years. So whether that's equity release, interest only, if you're an IFA, it's obviously pension transfers. It's, there's all these things where just because you can do them now and you can make money from them doesn't necessarily mean that you should, is my personal opinion.
No, I'm completely with you on that. It's like I'm a big advocate of, even just small little things in terms of networks might not want you to do certain things, but particularly if you're doing business by distance, it's like get all of the paperwork and collate it together, your fact find, your quote, your research, your application, your suitability letter, put it all into an electronic signature and just get it signed. Just for your own business, not for the network, for you. Don't care the network whether they need it or not. Definitely in a protection world, because when I set my protection business up, I've had 3 complaints this year due to non-disclosure. And the beauty is, first thing I do, ring the insurer, did the client return the checking your details form, as legal and general would call it, confirming that the information on the application was correct? All 4 of them, yes, they did. But if they hadn't, that's my PI, that's my thing. Now what we do is for every protection case, irrespective, send everything out, get an electronic signature, because if they don't return the checking your details, I've enforced it as one of the compliance structures that we have within Active, but it's just those little things that you need to dot the I's and cross the T's on and have extra coverage over and above your network, because it's for you.
Completely. I'm a big one on risk should be targeted, and any measures a business takes, whether that's a network or a smaller DA firm or an RI or an AR, whatever your structure. I think you need to understand what your risks are. And I don't mean broad company risks. I actually mean on individual cases and transactions. You need to understand what the risks are, and then you need to act appropriately. And what I'm very personally massively against are these kind of procedural, sweeping, slightly ridiculous risk requirements where you're trying to mitigate an event that happens, in 1 in every 1,000, 5,000, 10,000 cases. So I think there are broad things that are absolutely worth it, like you say, signing off protection disclosures, obviously anything to do with AML. But equally, there's some requirements that I, as an AR myself, still have to deal with. Where you're going, I know I'm only doing this because this happened once, and as a network, we would probably do 20,000 transactions in a year, and everyone's doing this one thing because it happened once. So even if you say, well, that's that, even if it only takes you 30 seconds, that time across all those advisors is huge.
Yeah. And exactly as you say, the job now, just in comparison, it's 80% admin. Everything takes 3-4 times longer. And like you said, some of the top 2 writers, I think one guy was called Mach, and I know the other one was called Sarah Gascoigne. I can't remember what Mark's name was, and they were number 1, number 2. But especially Sarah, poor lady, she looked like 5 years older than she was, but she was exactly as you said. She was awesome, but she was just a machine. She was a complete machine. She was 24/7. But on the commission structure that AH had, that was over £500,000 each that they were earning as a result of the business that they were doing. And it's just so difficult to do that in today's world as one person with a couple of admins. You're lucky to get close to half of that, unless you're dealing in the high net worth space.
Yeah, completely. And I find, particularly in the current climate, I find these kind of different approaches really, really quite interesting. So as I'm sure a lot of people, we're finding dealing with lenders very, very challenging in the current climate. Long wait times, moving goalposts, almost a desire to not lend at certain points, particularly these cases, these instances where lenders are pulling out of certain loan to values. And I personally certainly get this real impression that then anything that's still going through, there's a can we get it out? Can we get this out of the way? We don't want to do it, and fine, let's just find a reason. And I find those barriers really, really frustrating. But equally, we have a couple of cases going through that are, we've got a couple at $1.5 million and a couple at $3.5 million, and it's just leagues apart. The $3.5 millions are, we sorted those out with a few phone calls to some of the private banks we know, and they're sensible, they're common sense conversations. The documentation that they want and the underwriting approach is fantastic. It's, as I say, common sense. None of this, your accounts will sit in the queue for 4 days, and then we might ask you some questions, and we'll then take another 2 days to get back to you on those questions. And then once you've been through all of that, then we'll ask you to write it up into a COVID impact report, and then we'll make a decision. Okay, 2 weeks time, and it's just crazy.
Yeah. So it's a funny old world, and it's definitely a tricky one. But I definitely think it's one that's only going to get trickier, I think, potentially over the next few months, if anything at all, as lenders still continue to tighten their reins, and the furlough starts coming into effect and people start losing jobs and all that stuff. It's going to be a weird and wacky one.
Absolutely. I mean, personally, I wouldn't say I'm writing the year off, but certainly in terms of how we interact with lenders and the products that are out there and higher loan to values, I'm certainly not expecting a return to normality until early next year. I think there's some other things lenders have to deal with that we perhaps forget sometimes. I've worked for Lloyds, for example, and their back office systems are archaic, real like legacy green, black screens with green fonts, almost like DOS prompt type systems. So lenders, from a technology perspective, most lenders aren't set up to have people working from home, let alone do you want people working from home suddenly, looking at reams of bank statements and pay slips. So there are obviously, data control and governance issues that lenders have to deal with, or will want to take a risk view on. But similarly, they've got massive issues trying to deal with payment holidays, and potentially as furlough ends and redundancies happen, potentially arrears as well. So they obviously have to redeploy staff. And then if you think about companies like Barclays, half of their processing centres are actually overseas, some of them in India. So their capacity is automatically halved before you even start talking about social distancing, working from home, those issues with IT and all those other bits. There are challenges those kind of enterprise level banks that face that I don't see them overcoming rapidly. And that basically will trickle down to us. Yeah, interesting times. But to change gears slightly then, just to step back into your past a little bit with regard to, going from NS from a point of view of being an AR to a DA, and we'll get kind of into your current, where you're at the moment. NS, you were at NS at a time when they had just brought in new regulation in 2014, and they were able to grow from 12 to 60, managing in that role that you were sitting at then. What was kind of for anyone who's got ambitions of building the bigger than lifestyle business, the £5 million a year turnover company, what's kind of the considerations and the thought processes of going from 12 to 60 and going from AR to DA from that? It's a good question. Certainly for us at the time, cash flow was always the issue. It was like every morning and probably every evening, we would be talking about what was in the bank, what had come in, what was going out the next day, what was due in over the next few days. We'd constantly be looking at every advisor's pipeline. We had a real focus on, I don't know what terms people listening to this will use, but we always use the terms written and banked. So written was projected income, you've signed someone up, you're working on an application. Banked it's obviously in the account. And we were always looking at written and banked and let's say cash flow and whatnot. And you have to make sacrifices. And I think anyone that runs their own business already knows this, but if you really want to grow, you have to. So if you're sat there now and you're earning 100, 50, 100, 200,000, whatever it might be, and you've got, perhaps a PA and a power planner or an advisor or someone that does marketing, whatever that core team that you already have is, if you want to grow, from my view, the reality is you have to sacrifice some of your income for a time because you need to fund extra hires. If you want to take on advisors, we had lots of data around this after we were growing so rapidly, constantly. After we'd done that for 3 years, I could tell you to nearly the day we had projections. So I could tell you to nearly the day that our advisors would start becoming profitable. And the crux of it was, it's 6 months. If you're feeding someone leads and they're dealing with those and they start signing up reasonably quickly, you're looking at 6 months before you turn a profit. Not before they get cash in bank, because that would happen sooner, but until you get a return on the time and the money you put into that, minimum of 6 months. And you've got to cash flow that. So you either need reserves or you pay yourself less. And that's certainly, the founders at Ennis was something that we went through quite a lot there, where they get paid last. And that's the thing as a business owner. Everything else goes out first. So certainly cash and that willing to sacrifice it is key. Knowing your business inside out sounds like a really trite thing to say, but it's true. Where do you get your leads from? Who are you targeting? What are your conversion rates like? What's your process like? All of that. And then being agile. So again, sounds like a really trite, obvious thing to say, but I've worked at companies where it would take us weeks, if not months, just to get someone to say yes to something. Like, it doesn't have to be something big, but we want to tweak this process. We want to introduce some new documentation, whatever it might be. When you're growing, you need to be able to do that immediately. So don't be afraid. It doesn't need to be perfect. If you've got an idea, kind of hash it out, map it out, however you want to do that, whether you do it nice and formally on a lucid chart or a document or whatever it is, or you literally scribble it in the back of your notebook and then the next morning go, this is what we're going to do today. Do it. So be quick, be agile, test it. Don't be afraid to cut your losses. If you try something and it doesn't work, just get out quick. Don't keep putting money and time and effort into it. The other thing that is also really important that we found is how you pay people. Again, sounds like a really obvious thing to say, but for most, I would imagine for a lot of people listening to this, they're self-employed. And now whether they're self-employed on their own, or they've taken on people that are self-employed, or they work for someone and they've got this kind of self-employed structure, which is obviously very common in our industry. But as soon as you start talking about percentages, so if you're paying an advisor 40%, 60%, 80%, I can tell you can't scale a business beyond a certain point with that type of pay away. It doesn't work. As soon as you've got bigger premises, you've got DA fees, you're paying your FCA fees, you're paying your FOS fees, you're paying your PII, you're paying all these other staff. As soon as you start adding in marketing and admin and HR and training and all these things you have to have once you start to get bigger, you can't then pay all your advisors 60%. It just doesn't work. Certainly if people perform, yeah, absolutely. But there needs to be a point where people are profitable. They're earning for themselves, but they're also earning for the business, and they're still 10, 15, 20%.
Yeah, without a doubt. It's one of those questions. We'll get into that a little bit deeper as well, because the profit margins that advisors look at and see, but actually the profit margins of the business can tend to be two completely different things, can't they?
Yeah, 100%. There's also a management and kind of a culture issue that goes with it. My personal experience, and other people may disagree with this, but certainly my personal experience is when you're a small team, if you're all self-employed, like trading under a brand, then actually it works really well, because there's that kind of almost entrepreneurial, we're all in this together, let's do it type aspect, and people work hard and they get paid well for it. But there's kind of this critical mass point where you might then start saying, we want to focus a bit more on process, for example, or we've noticed that we're a bit weak in some areas and we want to give you training on that, or we want to do something about this. There comes a point where generally self-employed teams, some of them will be really on board with it, and others will just say, I don't think I need to do that, and I'm self-employed, so I'm not going to do that. So you get this kind of almost combative self-employed environment after a certain amount of time. And at that point, you have to make a decision. Like, do you deal with it in whatever way you want to deal with it and frankly live with it? Do you say, right, well, we're going to stop here because we like this kind of collegiate atmosphere? Or you have to go through a pain process, and I've done this at two other companies, Ennis being one of them, where you say we're going to move away from a self-employed model. So you either come on that journey with us, or we find a way that we can part ways amicably, and you move to an employed model. Salaries, validation points, pay scales, bonus tiers, whatever the model might be, but at that point, everyone's on board, everyone's on brand. You can manage people, you can work on culture, and you can basically get rid of anything that is toxic to that.
So do you think, in your opinion, where you've been, a self-employed model as a non-network or a company, as an AR or as a DA recruiting and growing, do you think to make it profitable and to scale, you must have an employed team?
I would say so, yes. If you really want to scale, then I 100% I would say yes.
Yeah, and what do you think when you say really want to scale? What numbers are you talking? The 60 that kind of Ennis had, is that what you think?
No, I'd say any more than a dozen. A dozen would absolutely be my limit if I'm looking at that model. Yeah, 100%.
So self-employed up to 12, over 12 roughly, you're then looking at employed. And what do you think, what, in your opinion, what's kind of the ideal, because this question gets asked all the time in the Mortgage Pro community, you know, how much do I pay my advisors? What shall I do on a self-employed? What's an employed? I get messages from people, I've been offered this, is it any good? What's kind of your thought process in terms of actually, as an employer, because lots of people are always wanting to employ, what's a good package to offer from a self-employed perspective and an employed perspective?
So I do agree with some of the things you've said on other messages and videos and comments and things about it really depends on the other things that you're offering. So if you're giving someone leads, for example, then that's huge. I think most people that haven't had to look at generating their own leads really don't appreciate the effort that goes into that, the numbers that are involved, and the value you should place on someone that's even willing to pick up the phone and have a conversation with you, let alone actually do a piece of business with you. So I think if you're providing, on the basis that you're providing leads, that you're probably providing some form of admin, whether that's immediately or at a certain, if they're banking a certain amount, the model I'm used to, and I've seen this, AH, Ennis, Knight Frank to a certain extent, and certainly other businesses as well. The model I would be used to is a basic of, call it 20, 25 to 30,000, depending on region, potentially more for someone that's really experienced, but you would have a validation point. So if you were, and that validation would tend to be between 3 and 4 times the salary, again, depending on business, the actual business model and what you're expecting from them. So if we work on the basis that you're going to pay someone 25,000, then you would expect them, and we say, if we keep it simple and say 3 times validation, you would expect them to bank 75,000 before they then earn commission. And then typically I would expect them to get, say, 20 to 30% commission at that point, and then it will tier up the more they bank. So at the point, for example, they banked 120,000, then you could say, well, actually you'll get 30% or 40%, you'll ratchet up. And then there needs to be a ceiling at some point.
Yeah, and I remember when I was at AH, you had the Rare Club, didn't you? Once you were banking 8,333 every month, you were then getting 40% of everything that you wrote, and because your basic kind of becomes null and void at that point in time. Once you've been there 6 months and you're doing consistent figures, their goal is they wanted everybody in Rare Club. To be fair, not many people actually were in it compared to 18.
It's aspirational as well, and as it should be. You're earning lots, you get nice perks. With AH, you've got the trips away. Knight Frank does something very similar. Ennis does something very similar now. Like JLM do. They call it like the winner's meal, and you go out to 2 Michelin star restaurants, and you have like these lovely days out, or you go to the Hurlingham Club. So companies do, every business I've been at offer these incentives for higher performance, and I think that's entirely appropriate because everyone's winning at that point. But I do, just to take it back a step as well, but I do think it's important that people also understand the costs that go with employing someone. So we're talking about 25,000 as a basic salary in that example. What you pay as an employer isn't 25,000. You pay 25,000. We'll keep the figures round. You're going to pay an extra 13% on top for your national insurance contributions. And to start with, fine, you can defer for 3 months, but you're going to be looking at a percentage on a pension as well. So we'll call it 2%. So you're going to pay 15% above and beyond just on additional costs, direct employment costs, let alone the cost of someone managing that payroll. Banking fees, they're going to be minor, but all these things feed in. Then you've got management time. So if you've got a team leader or a supervisor or a sales manager, whatever it is, say you're allowing 10% of that person's time to go to each person each week. If you work on that model, you're saying, well, if I've got a team of 10, I've got a sales manager. So if you're paying a sales manager, again, we'll call it for argument's sake, we'll call it 50,000 or even 40,000. Well, actually, that person that you're paying 25,000, you've got to add 4,500 to, because that's sales management salary that's got to be shared around as well. So, these things add up, and people really need to understand that if you're thinking about expanding.
Oh, without a doubt. And like from my perspective, being a DA, having a self-employed advisor, I don't charge a monthly fee to any of my 6 self-employed advisors. But when you take into account eKeeper license, 27 Tech, Solution Builder, email, and all the security that comes with that, Hello sign, checking IDs and sanctions, it's roughly, I think, somewhere between about, can't remember exactly, but say £600 to £750 per month as a cost for an advisor. Now, they can realistically, if you're giving them leads, they can cover that cost with the fees that they'll charge in that period of time. But you've also, like you say, you've got 5 days worth of training. You've got all those extra little bits. You've got the ops manager that's in there, Andrew, dealing with all that. Exactly. The cost.
Completely. If you've got, say, a HR person or a training manager or whatever these roles are, even if you're saying, again, it's very geo specific, because in London, that those roles are going to cost you £35,000-40,000. In mid England or home counties, you're probably looking at around 20 to early 20s. So these things, obviously, where you are or where these people are working can have a massive impact. But it still comes down to, if you're going to expand, absolutely go. I'm saying all this and I'm sounding like negative, and I'm not at all. I absolutely believe everyone should go for it. Just do it. If you've got the leads and you're satisfied that you can, after a period of time, generate that income, do it. Don't think about it. Don't pause. Just go. It's the most rewarding professional experience I've ever had, being in rapidly growing companies. There isn't anything like it. It's almost addictive. But just model it. Do your projections. Think about the points you're either going to want to move from being AR to DA, or that you are going to need extra admin, or you're going to need to think about a marketing manager, or if you're not employing, you're going to have agencies, but you then need to know the agency cost. So just do a little business plan, do a projection, do a model. It doesn't need to be massively accurate, but just do 6 months, do it to a year, and then do your year points 2, 3, 4, and 5.
Yeah, so having built out Ennis as an employed model and grown through that side of it, and then going on to move to JLM, who have got 75, 80 brokers, I think you said, as a network model. Yeah. What was the difference between the two models and the scaling aspects of those two?
So the scaling aspect is arguably the easier part, because there's less people involved. So JLM has a brokerage and a network. So I'm COO that covers both. They operate as one. But if we think about the network side, as you've said, the functions that are involved are less. So the main one is basically onboarding and compliance, really. So obviously, onboarding can be a very short or very long process, depending, a bit like dealing with customers. Do people package and give you all of the documents that you need up front? Do they complete their FCA long form A's accurately? All these sorts of things. So you need so an onboarding and then induction and training and T&C. That's one area that you need to focus on getting people in. But compliance is, I would say, arguably the biggest one, because that, for most people, that's their main interaction with their network. It's file checks, it's field visits, it's recorded calls, or whatever it might be. Having financial promotions signed off, it's doing the annual fit and proper checks and the annual tests, and market updates, compliance updates, and all these types of things. So scaling there is really about having people that can work in one of those functions, have the skill set. I think the challenge I've always found with hiring people into those roles is it's quite easy to find people that either have the right approach, whether that's analytical, or they can spot faults, or they can digest and hold information in their minds very quickly and easily. If you're looking at a case, for example, or a complaint, or they might be very technical. So you can kind of get what's needed for the job bits. But then getting that with someone that's got really good communication skills that's the real challenge. So you can get people that are good at one side or the other. Getting someone that's good at both is huge challenge. There's just not that many people like them. And I'm not being funny, but if they're good at both of those things, they tend not to end up doing a regular compliance role. So actually building a really good compliance team is really, really hard. Harder than building a marketing or a HR team or a training team by 100%.
Yeah, so that's the hardest part of building a network, effectively, the compliance aspect of it. And in terms of why would somebody, and I think this is probably kind of a thing, why did they, I can't think how to word the question. So they were a brokerage. What made them want to go and set up kind of as a network on the side? Because the profitability
for them it was very organic, and I know this is true of some other firms I know as well. So they primarily set up as a brokerage. That's how they started, and then they have great working relationships. Like Seb and Rory are great guys. They're probably, I would say, the nicest people I've ever had worked for in financial services. And they had people that wanted to work with them, but didn't want to basically be their advisor. They didn't want to be an employee, and they had their own ideas, whatever. So it was a very natural, organic thing. They had some people, they let them set up as ARs. It worked, and it just kind of grew from there. So it was never the original intention. It's almost happened by accident, but it's worked very well for them. So I think when I started work with them a few years ago, they were a bit smaller. There were about 60 advisors and just under 20 ARs. And obviously now that's an area of the business they're focusing on more, hence the growth. And as I mentioned, those things with then scaling up, onboarding, training, compliance, all these other areas.
Yeah, and the crazy thing, as you'll know, which everybody else won't know, is actually Rory, you mentioned, was actually my manager at Connells in Colchester, which was my second job in financial services around about early 2004, I think. So he's again.
He remembered your hair.
Yeah, my hair, my fake tan. Oh, those good old days.
Yeah.
The highlights that my sister used to put in for me when I was however old in that period of time. Oh, yeah, it's lovely. But no, Rory and I've been emailing actually. He's going to be coming on the podcast to talk in more detail about JLM. So that'll be interesting.
Oh, yeah, that'd be nice.
Yeah, that'll be cool. So from your perspective then, what's kind of, you've consulted, you've helped grow an employed model, you've helped grow an employed model kind of into an AR. I think, one of the questions that immediately people are going to have, and actually we were talking before this and you said you've been a broker for 18 months.
Yeah.
And you're now contemplating, or you're in the process of going DA.
Yeah, absolutely. And that isn't a reflection on Seb and Rory, as I say, they're brilliant people to work with and for. I'm used to being the boss, frankly, and being an AR for me feels like having a boss. I don't like the fact I don't have control over certain parts of my process, or there are certain things I have to do because it's a network requirement that I have. From my view, I would do differently. So I want control. It's as simple as that for me.
Yeah, no, it's exactly the same as me. 2008, June, I set up with Primus with a separate limited company and tried being an AR because I thought, I can't be dealing with checking all these advisors' files and all this compliance and everything else. And actually, having not really done mortgages for 7 years after the credit crunch and building an insurance brokerage, my compliance flew through. Try and say that speedy. Flew. I'm not even going to try again. My compliance went through quickly. And actually, exactly the same as you. I like selling my own ship. I like making my own decisions. It's better from that point of view. But one of the things that I know within the communities, networks always put this, or seem to, some networks, let's not generalize, some networks put the fear into advisors of going DA, that the FCA are going to knock on their door and they're going to, they're going to shut their business down and they're massively at risk and all of this. What's the reality, Daniel?
So the reality is no, that doesn't happen. What the FCA do pick up on is large changes. So, I mean, so the first caveat is they have the option to random audit and inspect and visit, or have a phone call, or ask you for an interview, or whatever they want to do. They can do any of that to any firm at any time, basically. There are then some benefits though. So people get very scared about it, and it feels very intimidating. And I was exactly the same the first time I had to do it. But I've been through probably half a dozen FCA, either interviews or inspections or visits now. So the reality is, no, they don't come knocking. If you go DA and you start submitting your Gabriel returns, which is your RMAR reports, and which is your business performance reports that you have to submit to the FCA. If you start submitting those and you grow very quickly, so if you double year on year, for example, they will ask you for an interview because their system automatically flags these big changes. And they just want to know where you're going. They want to know how you're doing it, where you're going. More importantly, they want to know that you are aware of the risks and aware of your own limitations. So they want to know that if you've either got other people on board that can handle things like training or onboarding or compliance or whatever it might be, or if you haven't, that you've got access to it. So you might have a compliance firm that comes in and does third-party audits for you, whatever it might be. So they just want to know that you're conscientious, effectively. But the reality is, no, you don't need to be afraid. What I would say you actually need to be more afraid of is lenders. So most, I don't know if people know this, but lenders and clubs will do random audits. So part of my job at some of those firms that I've worked at that we've spoken about was dealing with random risk audits or kind of unofficial flags. So if you've submitted an application and the lender isn't rejecting it, but looks at it and goes, these pay slips look a bit dodgy, or we've looked and we've realised it's a family firm, or actually it's the advisor's brother-in-law and they haven't declared, whatever it might be. If there's something they're a little bit worried about, then they actually, like most people in real life, they actually just pick up a phone. So I would deal with all these phone calls from head of audit, head of risk, saying, we want to have a chat. Has the broker that submitted this, do you have concerns about them? Are they okay? What's their recent compliance audits been like? All these sorts of things. And there's actually a lot of that goes on in the background. Now, if you have a negative outcome from one of those processes with a lender and they take you off panel, and I don't know if anyone would have had this before, it's like dominoes because lenders share intelligence. So if you're taken off panel with one lender, you can guarantee that within a period of weeks, you will then be taken off panel with a series of other lenders as well. Once that starts happening, it will just go around. And at that point, you can't do your job. So that actually is the bigger risk from my view than the FCA randomly saying, we want to have a chat with you.
Yeah, and it's. I can honestly say I think I've had one FCA visit since 2008 when I went DA, and in that scenario, one particular lender came out to see me doing an audit, and it was a university graduate who had his little check sheet, never been a broker in his life, asked me loads of questions, and the long story short was I got struck off of panel, and I shit myself, for want of a better word. Deliberated over it. They wrote back and said, you need to review all of the files that have been submitted to us. You need to find out what the problems are, blah, 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 blah. Long story short, I had told the university grad that we get documentation in from the client and we certify it and we hold it on file. Mm-hmm. When the guy who came out, who used to be a broker, who was doing the review, he turned around and said, the problem is you've told them that you've certified ID, but you've submitted it, all your documentation to NatWare, to the lender, uncertified. So you've submitted it to the lender uncertified. And I was like, well, and he said, I know why, because we don't require it to be certified. So it's like the reality actually, and long story short was he had to go back and he had to make a big case and basically I was on panel. But it was like, the reality of what actually happens day to day in the job, it's like, yeah, we get it in, we hold it. If we need to certify it, we'll certify it. But the lender didn't require it certified, and that was it.
Yeah, no, absolutely. And it happens a lot. And as I say, that was part of my job before. And thankfully, every one of those appeals that I've worked on, we've got through and had overturned. But to put it in perspective, then in the past 6 years, I've probably dealt with about 30 of those. So it's not massive numbers, but it's enough that it's something something that happens.
Yeah. So you're going to go DA. So you're self-employed now. You're an AR of JLM. You're going to set up a DA. What's kind of the next 12 months, 3 years, 5 years look like for your DA life? What do you want to do?
So we ironically, on the topic of talking networks, that's what I want to do. So I think it's important to stay current. So we will still keep a small advising team, just so we kind of, we're using the systems, we're engaging with lenders' processes, we have we're in the trenches, so to speak. But personally, from my view, I think there's something slightly fundamentally wrong with the advisor to network relationship. It's very dictatorial. You pay a certain amount for the privilege of being under a network, and I've worked in that space and I've been around that space for years, but I just think it just feels slightly unnatural. I think if you were setting up, if this market didn't exist and you were setting up the concept of a network for the first time, surely you'd position it as a service, not as you do what I say when I say it. You use the systems that I say you have to use. I mean, my analogy would be if I have an accountant, as I'm sure many people do. If I was choosing an accountant, I wouldn't expect my accountant to say, well, I'm going to handle all this very serious legal and regulatory and tax stuff for you, but you have to use Xero or QuickBooks or whatever system we use. You have to employ this structure when you employ anyone you take on, and you have to do things this way. I don't expect my accountant to do that. I expect my accountant to say, how do you work? Well, how do you want to give the information to us? How do you employ people? How do you want to do your taxes? What do you want? It should be a professional service, and I think that's what networks should be. It's my personal view. So we're looking at doing something a bit more along those lines, rather than the blanket, you lose 10, 15, 20, 25%, and you have to use whatever system.
And do you think in doing that method, like my immediate thought then was very much a case of, well, my thought process and my maybe naivety to a degree is the reason why networks do that is, yes, for control. Also, quite a lot of them are long in their tooth and been around for too long, that trying to get 2,500 advisors to change would be a freaking nightmare, especially as the age demographic of some of those probably wouldn't like any change. But coming in it from a new school angle like you're coming in at, how would you manage that at scale if you've got everybody using different systems, different sourcing software? One of the things that the FCA like is that continuity of everybody using the same fact find.
I disagree with that, actually. Okay. What they like is that you can prove that you're fulfilling your KYC requirements. So it doesn't mean it's habit. It's habit that everyone at a firm uses the same form. And it is easy to check, and that's it. So, and again, this is where I think the onus is slightly wrong, because surely the network's job isn't or management job on any DA, in fact, isn't necessarily to make it easier for the admin team or the compliance team. The purpose is to make sure the customer's getting the best result. So if the customer doesn't need to use a certain form and we can do it a different way, and that works in that instance, then I think that's something that should be explored. Now, it doesn't work for everyone. And certainly I think there is a lot to be said for consistency, but I just think we've lost this kind of tailored, bespoke approach that you would have with any other type of professional services. So to bring that back to the FCA, I think as long as you can show that the same information is being captured, just potentially in a different format, or the required information, we should say, is being captured, just potentially in a different format, then I don't see where the issue is. If you can show that you also have processes in place to ensure that data, however it is gathered and wherever it is then stored, but then ultimately that a copy is kept for the required amount of time, then again, you're okay. So it's not as easy to answer your question. How do you scale? It's not as easy. It is much more, hands-on and bespoke, but that just means it's a different business model.
Yeah, and have you got a vision in terms of how many you want under the network?
As many as we can get. So
going big. Going big.
Yeah, absolutely. But why not? Why? You know, at this point, as I sit here, lifestyle-wise, I'm saying actually, you know, if we had 20 firms, brilliant. You know, I can manage that with a nicely sized team. We can manage that, generate some nice amount of income, and it's nice to use that word again. But why stop? So yeah, I might get to that point, and we might enjoy it for 6 months, and you know, have a bit more time off during the week, have a few more treats for you know, here and there. But why stop? If it works, any model that works can be expanded, but you just might need to tweak things as you go. So I absolutely think there is no reason why we couldn't go bigger. Now, I think we'd probably hit a ceiling. You know, I don't think we'd be able to do the size of like Primus, for example, or MAB with that kind of semi-bespoke model, because then that is very challenging there's just too many moving parts. But I certainly think we can get, you know, we could easily get up to, you know, a big number.
A big number, nice. And out of any inclination, one of my favorite things, you've mentioned process a lot today. Any inclination in terms of the system that you're going to be used to manage the processes or anything at all?
Yeah, so that's a good question, actually. Well, so one of my key things is I think firms should be able to use their own CRM.
Me too.
The issue with a network is having accurate information to be able to submit your FCA returns, access information for audit, access files, for audits, and having a good copy of all of that information for potential future complaints. That's your three things. So I think advisors should be able to use whatever system they want, and we can work around that. So the simple answer is we're not going to have a system that advisors have to use. We currently use Pipedrive, but that's not good for scale. That's great as a kind of a smaller lifestyle business while we're setting everything up, and it's very quick and easy to use, and I love the integrations. At scale, we will probably either go back to Mortgage Keeper, or I haven't seen. So I've done loads of CRM implementation projects. So I've seen near enough all of the ones in the industry. The ones I haven't seen for a while that I'm quite interested in revisiting is what's the name of it now? Smarter.
Yeah. And Mortgage Magic seems to be popping up here, there, and everywhere.
That's the one I've not seen. So I've seen like the Bluefin one. Obviously, I've done the 360 integration. I've seen all of the ones that have grown out of the wealth management side. So, you know, like Xplan and IntelliFlow and all of those. But Mortgage Magic is the only one I've not yet seen. But what I tend to find with systems like that, the young systems, they're good for kind of one or two people. They're not good for bigger than that. You know, you don't have really good workflows. You don't have good user management. You don't have good reporting. They're just a bit kind of rough around the edges, which is why I say I'm intrigued in seeing Smarter, because the last time I saw it, it was good, but it was very, you do it the way Smarter wants you to do it, and you can't change anything, which again doesn't really work for me.
Yeah, makes sense. So as a final thought then, for anyone joining the industry, long in the tooth in the industry, considering employed or self-employed intrapreneur kind of role where they've got freedom, autonomy to focus on clients, but like my advisors, they're supported by a brand, AR life, DA life, what's kind of the main consideration that people should have and think about when choosing the right route for them or thinking about a change? For example, talking to one of my ladies yesterday, one of the ones that I coach, Katie, and she's like, I really want to go DA. And it's like, but why? Long story, we didn't focus on that. Now that's something we're going to review in 6 months from our sessions. But for people who are thinking about changing, bit of DA, maybe I'm not happy with my network and all of that, how do you come to a conclusion of what's the right one for you?
I think you really need to, for me, if I was kind of really boiling it down to the basics, firstly, you need to be absolutely comfortable with whatever route you choose. So if you feel like you're doing something because you should be doing it, not because it feels like the right thing, then you're doing it for the wrong reason already at that point. So you need to be absolutely comfortable that you are going down the right route for you. you need to also be very honest with yourself about how much you want to put in and what you want to do. So if you want to go out and find your own leads, if you want to write your own processes and want to write your own literature, and you don't want anyone kind of telling you how it has to be, then DA. And you could be DA but be supported through using agencies or consultants or whatever. If you want the consistency of knowing I'm going to have a certain amount of money coming in each month, I don't have to worry about where my leads come from and all that type of thing, then actually at that point you've got so many options. You can be a franchise under someone, you can be a self-employed advisor under an AR or a DA, you can be an RI, you can sub-brand yourself under another company brand, because I know that lots of places will do that for an RI as well. There are so many models if you want the slightly more, should we say, straightforward, simpler kind of structure, employment. But it is employment, however you dress it up, and you might pass the IR35 rules, but you are employed, really, is my view. So I think you just need to be clear on how much you want to put in. If you're comfortable with the uncertainty, and whether or not you have aspirational plans to grow, or you just want a lifestyle business, you need to be really, really honest with yourself whether you want to have to do everything, or whether you want someone else to do most of that for you and you just take a cut.
Nice. Cool. So thank you very much indeed for your...
No, thank you.
Today. Hopefully it's given people a bit more of an insight into the industry, which was the main goal. Have you chosen on a name for your network yet that everybody can keep an eye out for?
We're probably going to keep it in line with the existing. So I trade as my company at the moment is Liberty Mortgages, and the network is going to be the company name is Liberty Mortgages Group, but we'll probably just trade as Liberty Group.
Nice. So keep your eyes and ears peeled for Liberty Group coming out. No doubt. Obviously, we're still connected. So at that point in time, if you want something a little bit bespoke, or you want to have, a chat with Daniel, then where's the best place to do that, Daniel? Are you a LinkedIn or a Facebook man, or?
LinkedIn more than Facebook. So anyone in the academy as well will see my details in there. But if anyone wants to have a chat, you can just call me on 07930 305 382. You can find me on LinkedIn. I'm on LinkedIn under slightly long story, but I got married and we took a new name, so that's still going through. So on LinkedIn, I'm still down as Daniel Leach, Leach, or you can just email me, daniel@libertymortgages.co.uk.
Nice, mate. I'm excited to see where this is going to go over the next period of time. We'll definitely get you back on as it starts to your authorization goes through and you start to on. Be awesome.
For anyone that just wants to have a chat, so I'm not kind of pitching or trying to plug going down a certain route, but for anyone that genuinely is growing a business or wants to have a chat about how they employ someone or just has general questions, I'm always happy to give a bit of time to people.
Yeah, nice. Appreciate that, mate. And obviously, I can't leave without the usual question of, this is the Financial Pro podcast. So what does pro mean to you?
I wasn't expecting that question, actually.
Come on.
Pro to me means basically doing the best that I can, but really it means smashing it. And that's it for me.
I love that. I'm going to get that as a soundbite and use it as the intro. Pro just means smashing it. That's like a man after my own heart. Nice one. Well, thank you very much indeed, my friend.
Thanks, Gary.